All right, let's look at our first type of adjusting entry. This is when we have purchased something and it hangs out as an asset on our balance sheet, and then we'll use it and it will become an expense. So let's go back to our dog grooming company and assume on July 1st, we buy $1,000 worth of supplies and pay cash. So this is a normal chapter 2 or chapter 3 entry where we're going to debit our supplies account and credit cash. We're debiting supplies because we need this supplies account to represent all of these supplies, this $1,000 worth of supplies, all this shampoo, getting ready for a dog grooming business. And we're crediting cash because cash is coming out of our bank account to actually pay for our supplies. Now, time rolls on, and it's July 31st, end of the month, and we're about to make our monthly financial statements. And we realize, holy smokes, there's only $400 worth of supplies because we've been using them all month to, earn our revenue, scrub our dogs. So, if we reported on our balance sheet the current balance of $1,000, we'd be lying because we don't actually have that many supplies. So here we go. We need an adjusting entry. We need to fix that account. There's also no supplies expense showing. And clearly, we've used up $600 worth of supplies, because if we had $1,000 and we only have $400 left over, well, we must have used up $600 scrubbing the dogs. And remember, an expense is always the amount that we've used up. So we're going to debit our supplies expense account to show that we've used up $600 worth of supplies during the month. It's going to show up on my income statement, and then credit $600 to supplies because we're subtracting out $600 worth of supplies. So our ending balance is going to be $400, what we actually have. Remember, it's the ending balances in these accounts that get reported and represent the company. All right, here's another example. August 1st, we buy a 1-year insurance policy for $1,200 for our dog grooming company. So here we are at August 1st. We're going to debit our prepaid insurance because we have this huge policy to use for the next 12 months, and credit our cash account because we're taking money out of our bank account to pay for the insurance. All right, now let's assume it's December 31st and we're making our financial statements for the end of our fiscal year. So we look at that prepaid insurance account. Holy smokes, it still has 12 months of insurance in it. And I know we've used up a bunch of that insurance. We've used up 1, 2, 3, 4, 5 months of insurance. So if it costs us $100 a month for insurance, we've used up 5 months worth of insurance. We need to capture that in an insurance expense account. So we're going to debit our insurance expense. So that shows up on my income statement that, yeah, it's taken $500 in insurance to run the company through this year that we're going to look back and report on. And forward thinking, if we're thinking about our balance sheet and what we have 7 months worth of insurance left to use in the future as of December 31st. So again, we're focusing on the balance of our accounts, making them right with an adjusting entry. Now, what you need to do is go to our eLearn site and look for these Chapter 4 questions to be done. Click on them and download them. Please try A and C of this question. And so you'll see the question is M5 or 4-5. So try to do part A and C. And then you can check your work here. Thanks and have a great day.